So we'll now start with partnership. Now, in partnership, especially accounting, what are the types of illustrations may be expected? Okay, let's see. In case of partnership, first of all, you have to understand some of the basic calculations related to partnership introductions like, and second one is all about understanding the reconstitution of partnership firm, which is nothing but admission of a new partner, retirement of an existing partner, and sometimes one of the partner may be admitted instead of another partner's retirement, so admission come retirement. And sometimes some of the partners may, or one of the partner may died, so how can we handle? These are the second set of component you have to study. Most probably you may expect the questions from this component. Okay, this second component, admission, retirement, admission come retirement, and death. And what happens in case the company is closed, a firm is closed or dissolution? Okay, so you have to understand this dissolution part also. Here we have a piecemeal distribution as well as a single lot closure of the business. These two angle we have to study. Clear? And of course, all the three will be applicable for the CA Foundation as well as CMA Inter Group 1. The fourth block is all about amalgamation, absorption, sale to company, etc., or conversion of company. This part will be applicable only for the CMA Group 1 Inter. And also in your examination, this content is least choice, because the advanced version of this you will study at your final. Anyhow, you need to have a basic idea about this calculations at your inter level. So 1 to 3 will be common for CA Foundation as well as CMA Group 1. Right. In case of introduction, what are the things that are going to be studied here? Predominantly in introduction, you have to understand how to appropriate the profit earned by the partnership firm. Okay, by preparing the P&L appropriation account. P&L appropriation account. In your final accounts, you prepare trading account, P&L account, and directly you will go for the balance sheet in case of a sole trade business. But in case of partnership business, whatever the net profit we found out, is going to be shared among the various partners. That will be now shared among the partners, that will be called as P&L appropriation account. So the profit earned will be appropriate to various partners. After appropriating, those appropriate an amount will be addable to the partner's capital account. So you have to prepare capital account also. So as you are aware about the final accounts preparation, trading and P&L account balance sheet, here our focus is to how we can distribute the profits and losses to the various partners and how this is going to be incorporated in the capital account. This component only we will be studying here. Okay, P&L appropriation account and capital account. Capital account. Is that clear? These are the two cases. Okay. Now, in capital account, we have two models of preparation. One is either fixed capital method, another one is fluctuating capital method. Is that okay? The original investment made by the partner remains same or constant irrespective of the any profits or losses of the business over the period, right? Whatever the profits or losses the firm earns will be accumulated separately, prepared new account called current account. So, fixed capital account along with the current account will be prepared, or both combined put together will be called as a fluctuating capital account. This will be the set. Okay, this will be the set. Apart from that, the second part will be past adjustments. Past adjustment related to either rectification of error or related to change in the deed. Okay, so if you want to be master in this particular chapter, you have to be master here. This is similar to the rectification of errors, like as rectification of error chapter needs more understanding of the accounts. Similarly, the rectification of the thing what wrongly done earlier to share the profits and losses to the partners will be complicated one. That will be named as past adjustment. Clear? So you have to understand, while appropriating the profit earned to the partners based on the contribution made by the partners, they will be shared. Probably some partner may contribute more finance. They may be offered with interest on capital. Some partners may take care of the means running of the business by taking care of the business physically day long. Then he may be offered with salary, some commission. So those things are also be considered here. So you have to understand these two blocks so that you will be master with it. Okay. So what are the things are there? Let's see. In case of P&L appropriation account and capital account. Okay. P&L appropriation account and capital account. And capital account. Preferably, the capital account can be prepared in the form of columnar form, or you can prepare each and every partner's capital account separately, also no problem. So we assume that we have the two partners A and B. A and B. Clear. Now share the profit earned to the partners. So by net profit. How do I get the net profit? The net profit found out by preparing the trading and P&L account. By preparing the P&L account, we got the net profit. In case of sole trade business, that net profit is directly added to the capital account in the balance sheet. But in this case, this net profit earned by a team of partners, okay, a group of members, right? As this net profit is not for a single person, now you have to identify to whom this money is going to be transferable, and before deciding to whom it is going to be transferable, based on their contribution, usually we make a decision, like, but not necessarily, but it may be logically correct. Probably some of the partners may work day long, he may be offered salary. Some partner may finance better than the others. Three partners, A and B contributed 1 lakh each, but C contributed 5 lakhs. So he says, I cannot come and work, but I have money, I can invest 5 lakhs rupees rather than 1 plus 1 lakh. So then additional investment, he demands some money, no? What is expectation? If I could have invested somewhere in the bank, I may get interest, right? Similarly, instead of investing somewhere, I am investing in this business by taking the risk as a partner. What will it give me? So he'll take the interest on capital. Some partner may say, I have a good contact. So because of my contact, I can get the order, sales order. And I can purchase the material at the much discounted value. Because of my own contact, I am able to contribute for the business. What will be your contribution? So we'll just take the commission. Commission, is that okay? The working partner will get the salary. The finance contributor may get interest on capital for their financial commitment done for the business. And some partner may give some guidance by way of showing the contacts, and that will be the commission. And ultimate risk. So because of running the business, there may be either profit or loss. In case of profit, okay, very happy. In case of loss, come and help me to share the loss. That's how the other partners are shouldering, right? So for that, profit or loss will be ultimately shared as per their own agreement. Okay. So all the amount, the net profit will be shared to all the partners as per their own support given to the firm. That will be transferable to the capital accounts credit side. So start with the opening capital. After adding salary, interest on capital, commission, and finally whatever the leftover profit shared among the partners equally. So or any of the ratios accepted. Final value will be the change or new value here. New value here. Is that okay? Preparing this one is called P&L appropriation and capital account. In capital account, we have two capital account. One is fixed, another one is fluctuating. Now, the partners who invested here may demand what? Sometimes. So for running my business life, I need some constant return, constant money contribution for my family requirement. Okay, you can take, that is called drawings. The partners can invest and further invest as per the expansions requirement for the business. Similarly, partner has invested all the money for the business only, so he expects some demand, expects some money, so he can get it back. So in this case, amount drawn by him will be subtracted from the capital. As he invested, he demands the interest on capital. Now he withdraws, then firm demands some interest to be payable by partner to the firm, right? That will be shown here, interest on drawings. Interest on drawings. So the drawings also reduces the capital, interest on drawings also reduces the capital. Okay. The ultimate closing balance will go to the balance sheet. So preparation of P&L appropriation and capital accounts are predominant one here. To make the illustration complicated, I'll now give some adjustment like for calculation of interest on drawings, interest on capital, even profit sharing, even commission to the partners. So we'll now understand how these things may be confused in your examination, right? Interest on drawings, interest on capital, profit guarantee, and commission to partners. Let me try to finish up this one first of all, P&L appropriation account and capital account, and then I'll just go for handling these four parts separately, the variance also. With that, this part will be completely over. Okay. And past adjustments related to the rectification of errors, like some error may be happen, can be rectified, or if there is any change in deed. Change in deed is nothing but the agreement between the partners. The profit may be shared equally. Sometimes later they want to change the partnership profits and losses. Instead of equal, it may be 3:2 ratio or 4:3 ratio, like this. Okay. So what happens, A and B join together and start run the business, and committed to take care of the business equally. So they agreed to share the profits and losses equally. Sometimes later B could not come to the business regularly, and B says to A, I cannot come to the business regularly because of my personal commitment, or I have the other job. So you have to take the responsibility of running this completely. Okay, I will take the responsibilities of running the business completely. But how can I share the profits and losses equally as the agreement we have made earlier? Okay, because of the extra commitment given to you, now you will be offered higher share profit. Hereafter, it's not 1:1 ratio, it is 3:1 ratio. Give me only one share, you take 3 share. Okay, since how long? Since up to you again present to the business as a physical contributor, we will share this way. Since from earlier date also will it be applicable? Sometimes it may be applicable from the earlier date also. In that case, it is called change in the date. Change in the date. Hope you will be now able to understand. So in the practical problem, P&L appropriation and capital account is the first block. In P&L appropriation, net profit is shared among the partners for their capital contribution, for their contact development, for their risk-taking ability, and for their physical support salary. Even they may withdraw money, and for that the firm will charge some interest. All these things put together will be first block. Second block is all about past adjustment, rectification of errors, and change in deed. Okay, this is the first set, named as introduction. Named as introduction. So in introduction, we are going to study two aspects. One is P&L appropriation along with capital account, and second block is all about past adjustments. Past adjustments. Second will be admission, retirement, death, retirement, death, admission cum retirement. Okay, this is the second block. Third block, dissolution, closing the partnership firm. So these are the three blocks we will try to finish up first of all. Under this, what are the things you have to understand separately? You may be asked to do some calculations part for the interest on drawings calculation, interest on capital calculation, and commission calculation, and profit sharing ratio, PSR. Okay, profit sharing ratio. These are the four aspects you have to understand separately. Let me finish up the first part, this one. Okay, so these are the illustrations 1 to 5. 1 to 5. I can solve the question number 1 to 5 later. I will directly go for solving the question number 6. Okay, I will try to finish up question number 6 now. Is it readable? Readable or not? So we'll start with question number 6. Thereafter, we'll move on to the other illustrations. Question number 6. A, B, and C are partners in a firm with capitals of 50, 40, 20 respectively. They share profits and losses this way up to 10,000 in the ratio of 4:3:3. The profit above 10,000 will be shared equally among the three partners. The net profit of the firm for the year ended 31st December 24 is amounted to rupees 10,000, 40,200, and then the drawings also listed here. Yes. You can prepare the P&L appropriation account. Come on, join with me to solve this illustration. Make it faster. Three partners are there. Okay. Three partners. I'll finish off the P&L appropriation account first and then partners capital account later. So P&L appropriation account, P&L appropriation account and partners capital and partners capital account. And their capital being 40, 50, 40, 20 respectively. Capital being 50, 40, 20. $50,000, $40,000 and $20,000 for A, B, C. The net profit of the firm, okay, by net profit. How much is that? 40,200. And drawings for A, B, C being 6,000, 5,000, 3,000. Capital account may be in thousands. This is capital account. You are required to prepare the profit and loss appropriation account for the year ended and capital accounts of the partner, assuming the partner's capital are fixed. I'll now finish off calculation of partner's capital account under fluctuating method. Okay, this is capital account under fluctuating method. Thereafter, I'll just convert that into the fixed method easily. There will not be any complication. After considering the following adjustments, interest on partner's capital is to be paid at the rate of 10%. So capital being 50, 40, 20. Now you have to pay interest for them, interest on capital. Payable to A, B, C. On their capital 10%, 5,000 for A, 4,000 for B, 2,000 for C. And interest on drawings also be charged by interest on drawings. If the date of drawing is not given, it is better you can calculate only for the half year. It is always assumed. If the date of drawing is not given, then you have to calculate only for half year, because we will not sure when he has drawn this. But without the capital, the business will not run. So we assume that the capital exists from the day one. But the drawings may not be applicable from the day one. Whenever he is in need, he may withdraw. But we are not sure that he might have withdrawn at the day beginning of the year or lost. So it's a rough calculation. We can take half of the years. Right. So instead of 5%, it is 2.5%. So 6,000 into 2.5%. Come on, tell me the value. 150 for interest on drawings of A. For B, 120 for B. 3,000. This one is 125. And the last one being 75 rupees. A to receive salary 5,000 per annum. So salary is given to whom? A. How much is that? 5,000 rupees. B and C get a commission of 10% each on net profit. So commission. So A is supporting the business to run the business full day by running full day, and BC contributes by way of business development, showing his contract. So he is given commission at the rate of 10%. 10% on 40,200 being 4,020 is the commission for B, as well as another 4,020 is the commission for C. So after that, you finish up tallying this. Come on. What is the value you are getting? Net profit shared for A, B, C. Come on, tell me. 40,000, 550. 40,000, 550. Now, what is the ultimate profit for these three partners? 16, 510. How I am going to share this? Up to 10,000 sharing ratio is different. Up to 10,000 4 to 3 to 3 is the ratio. Beyond that, how much we have? 6,510 will be shared equally. So 4,000 for A, 3,000 for B, another 3,000 for C. Up to 10,000 rupees of profit, all the three partners are sharing the ratio of 4 to 3 to 3. Any profit beyond that will be shared among the three partners using equal ratio. So in this case, it is 2,170. Am I right? Yes or no? 2,170, 2,170, 2,170. So now A's capital, A's share of profit being 4,000 plus this one, 6,170, 6,170. B will get 5,170, C will get 5,170. Hope now we'll be able to understand all these things. Now we can prepare the balance sheet, that means capital account. So I'm going to follow both the methods, fixed capital as well as fluctuating capital method. Let me finish up the fluctuating capital method first of all. Let me finish up fluctuating capital method first of all. Okay. Now, capital account. If I say only capital account, it represents fluctuating capital account. You no need to write as fluctuating capital account. Okay. So if you have been given capital account along with the current, then that capital account is called fixed capital account. Okay. So here we have three partners, A, B, C. A, B, C. Start with writing the capital by balance, opening balance. For A, 50,000. For B, 40,000. For C, 20,000. 20,000. And from the capital, he has withdrawn two drawings. How much is withdrawn by A? 6,000 withdrawn by A, 5,000 withdrawn by B, 3,000 withdrawn by C. Hope now we'll be able to understand. Clear? Apart from that, the amount meant for the partners from the profits will be shared to the partners, shown in the credit side of the capital account. Credit side of the capital account. I will transfer all these things. Interest on capital, P&L appropriation account, the profit appropriated for the interest on capital. A gets 5,000, B gets 4,000, C gets 2,000. And for their physical support, salary will be given, supported only by A, so he is eligible for salary, not for B and C. And B and C are now considering the commission part as per their own contribution given by way of promotion of the sales, 4,020. And profit and loss, for A, he gets 6,170, and B, he gets 5,170, and C, he gets 5,170. Okay. And for drawings, now they have to be charged with the interest on drawings. That should be in the debit side, interest on drawings. The value being 150, 125, and 75. Clear? Now, finish up telling this. The final balance will be the balance carried on transferable to ABC's capital account or their capital in the balance sheet. The total being 66,170, am I right? 66, 170, 53, 190, 31, 190, 66, 170, 53, 190, 31, 190. So balance carried on being 60,000, 20, 48,000, 65, 28,000, 115. So this will be called as fluctuating capital. Fluctuating capital. In case of fixed capital, small change. To this extent, it remains same and named as fixed capital. Thereafter, the second block will be called as current account. Okay. So you are not going to study it separately. See here. This part will be called as fixed capital. The value being balance, opening balance and closing balance remains same, 50,000, 50,000, 60, 40,000 and 20,000 rupees. This will be named as fixed capital. This part will be named as current account. Second part will be called as current account. Clear? So 50, 40, 20. The initial capital remains unadjusted due to the appropriations of profits and losses. That appropriation of profits and losses, including the drawings and interest on drawings, will be separately shown under current account. If I tally the current account, yeah, of course, find out the balance here. Actually, this will be 11,170 and this will be 13,190 and finally, huh? First one is okay. First one is 16,170, 13,190 and finally 11,190. Okay. So 16,170, 13,190, 11,190. So from this total, you subtract the initial capitals. That's what about the balance of current account. Now find out the balance carried on in current account also. 10,080 is at 20 and 8,065 and 8,115. So from this balance, you remove the current account balance. Balance will be the current account balance. Is that clear? Shall I move on to the next one? So this one is very, very friendly topic because you might have studied this at your plus two. Right. In your plus two, I think it carries around 30 or 40 percentage weightage. Partnership alone. Okay, partnership and company accounts, where the major time spent only learning these two chapters at your plus two. So here also it's very friendly only, but here are there some basic and detailed concepts will be explained so that you will be thorough with that, right? If it is clear, text me so that we'll now move on to the other illustrations. Now, question number 1, calculate interest on drawings, which is nothing but drawings against profit. So, what happens here? Partner invests the capital, right? Bank for what? Capital contribution. Maybe 1 lakh. Apart from that, because of running the business, they may get the profits and losses. So, profit and loss appropriation like salary, profit, commission, etc. Maybe another 50. Right. And he may be in need of fund for his own family called drawings. Now the question is, how will he be able to draw drawings? Will it be out of this one or this one, sir? If he draws out of this, sir, anyhow this year I may expect 50,000 rupees distributed from that partnership firm. I need to take around 40,000 rupees for my personal requirement. Can I do so? Yes. Usually, drawings is nothing but withdrawals of his profit. Withdrawals of profit. Sometimes later, he may be need for a emergency requirement where his drawings is more than the amount available by way of profit. So he says, I have invested almost 1 lakh, I want to withdraw from the business. Somebody may take up. I may withdraw my capital. I want to reduce my capital contribution in this business because I plan to go for some other major investment in my life. Okay. So he wants to go out of the business, at least 50%. He says, out of this 1 lakh, I will take around 50,000 rupees. Okay. This one is called drawings out of profit. This one is called drawings out of the capital. Clear? In case drawings out of the profit, you can calculate interest at the applicable rate. If the interest on drawings is okay at the rate of 12%, interest on capital being 15%. For this 40,000 rupees, you have to calculate interest at the rate of 12%. Actually, date of drawings is missing means you have to calculate only for half year. Am I right? This is how we can calculate. What about this scenario, sir? If the drawings happens from capital contribution. In this case, 1 lakh is investment made. For this 15% interest is payable by the company or by the firm to the partner. Using that 1 lakh, investment made by him is withdrawn by him. He himself withdraws. How much? 50,000 is withdrawn. So now his capital itself only 50. No. For that 50, only this 15% rate of interest is applicable. Hope you will be now able to understand the difference between drawings out of profit, drawings out of capital. Here, it is all about drawings against profit, and this will be drawings against capital. You have to understand the small difference between the two types of drawings: drawings out of the profit, drawings out of the capital. In case of drawings against profit, you can calculate the interest on drawings as usual case. What we have done earlier, that can be followed. In case of drawings against capital, from the capital you subtract the drawings. For the balance amount, you have to calculate interest on capital. Okay, you cannot say, sir, can I subtract from the 1,50,000 this 40 balance 1,10,000? Can I calculate interest on this? No, it's not possible. Hope now you'll be able to understand the difference between interest on drawings calculation, where the drawings against profit, drawings against capital. Clear? Now, let's start with the first question. Calculate interest on drawings against profit, where the interest on drawings being 12%. A withdraws 10,000 every month beginning for the full year. Every month beginning. Is that okay? Now see. Okay. Probably a year starts with 1st January. Okay. 1st January. Otherwise, 1st April, like I can have 1st April 24, 1st April, 1st May, June, July, August, September, October, November, December, 1st January 25, February 25, and March 25. Is that okay? How much he is drawing? He is drawing around 10,000 rupees every month. Okay. Drawings. Here 10,000. Okay. 10,000. 10,000. 10,000. 10,000. Okay, such a way he draws 10,000 rupees every month beginning for the entire 12 months. Right, I am calculating all these things in a detailed manner to make you understand in short. How can we arrive a small formula for calculating interest on drawings directly? For arriving the formula, I will just explain all these things in detail. Thereafter, you can go for calculating the interest on drawings, in this case, easily with a small formula. Okay, let's see. Now, what is the year end? Year end being 31st March 25. Come on, tell me. The drawings happen on 1/4/2024. Say rupees 10,000 carries how many months interest? From here to here? 12 months. So, the number of months eligible for interest in this case being 12, for this 11, for this 10, for this 9, 8, 7, 6, 5, 4, 3, 2, 1. Is that clear? So, what you have to do? You have to calculate interest for every value separately, the interest rate being 1%, 0.01. 12% per annum, otherwise 1% per month. 1% per month. Is that okay? How can you calculate here? Calculate interest for this 10,000 for 12 months. 10,000 into 12 months divided by 12 months into rate of interest per month being 0.01. I think this value being 1,000, am I right? Is that okay? 10,000 into 1 year and 100 rupees. Okay, 100 rupees. Clear? 100 or 1,000? No, I just make correction. 0.01 per month. How many months are there? 12 months. Now you will get the value. I think it is 120. Yes or no? 1200. 1200, right? Right. Now for the second one, you have to calculate for 11 months only, 1100. Such a way, if you calculate independently, what's the final value? Every month after 100 rupees will be reduced. Okay, isn't it? If you calculate. Now, what is the final value? Come on. The interest on drawings will be 7,800. 7,800. Clear? You are getting this, right? There is another method called product method. Another method called product method. Product method is nothing but you have to multiply these two. Product of these two numbers. What is the product value? 1 lakh 20, 1 lakh 10,000, 1 lakh 90, 80, 70, 60, 50, 40, 30,000, 20,000, 10,000. Get me the summation of the product. 7,80,000 rupees. Am I right? So if you get the product, summation of the product, okay, how do you get this? Drawings into month and do the summation of this. Multiplied with rate of interest per month. Rate of interest per month. 7,80,000 rupees into per month rate of interest being 0.01. So ultimate value being 7,800. You can calculate interest for each and every drawing separately, or you can kind of find out the product value. Product value is nothing but what? Drawings happening for every period multiplied with the number of periods eligible for the interest. Can we calculate based on the days, sir? Of course, you can calculate based on the days also. If you want to calculate the interest based on the days, what happens? You know, from here to here, 365 days. And from here to here, 30 days is lesser, 335 days. Such a way also you can do the product method. Drawings into number of days eligible for interest. You multiply the drawings with the days, you will get the product in days. If you are getting the product in days, you have to calculate interest per day. Also, you will get the same answer. Who will work this way? Who will work out the calculation of interest this way, per day basis? Huh? Usually bankers. In bank, you deposit, withdraw now and then, so the banker has to calculate interest. No, for each and every day, our money will be in the bank, you will demand interest, and banker demands interest if it is being the loan. So in the bank, they follow the product method, that too based on what? Daily basis calculation. So you now understand what is called product method. So product method is nothing but amount of drawings or amount of investment, whatever it may be, eligible for number of month or number of days. You multiply that, that is the product. If the product is based on month, then you have to calculate interest for a month. If the product based on the days, you have to calculate interest per day. You will get the same answer. Clear? Now come on. Now come on. The last. I am going to guide you the formula also. What is the formula here? Now, if this value remains same month after month, you can take 10,000 as it is, and you can take the summation of this value. What is the summation of this value? 1 to 12. You might have studied, isn't it? N into n plus 1, n into n plus 1 by 2. So 12 into 13 by 2. What is the value? 6, 78. You get the value easily. So if you are drawing the amount every month beginning, okay, draw even money or equal amount every month beginning, then very simple. Okay, how can you calculate? Monthly drawings multiplied by 78 into 12%, but you have to convert that into Okay, you have to convert that into daily. Okay, otherwise 78 months is converted into month by this way. 78 divided by 12 into rate of interest. 78 by 12 is what? 6.5. Or you can use 13 also. You might have studied this one in your school days. The formula for calculating the interest on drawings where the drawings happening equally at the month beginning. You have to multiply monthly drawings into 13 by 12 or 24. That's how the question may be, the formula may be drafted. So you now understand the formula derivations also. Monthly drawings into 6.5 into rate of interest is the formula. So here monthly drawings being 10,000 and 6.5 is the number. You can easily mug up this. How can you mug up this? Very simple. If it is being 12 months, summation of 1 to 12 will be this number 6.5. Okay, but you have to divide this by 12 to convert that into month, year. So you have converted that into the month to convert back to the year. So I had to divide this by 12. So 6.5 multiplied by rate of interest being 0.12. Hope you will be getting 7,800. Is that clear? Now B withdraws 15,000 every month end. What happens in this scenario? Drawings being every month end. Instead of 1st April, if he draws on 30th April, how much? 15,000. Rather than 12, it will be only 11. And it is 10. Finally, if you draw on exactly 31st March, it carries no interest. Then apply the same formula. Draw every month end. How will you calculate? Monthly drawings. How will you get the value? Only 11? No. 11 into 12 by 2, then 66 by 12 to convert back to year. So the value being 5.5, isn't it? So now monthly drawings into 5.5 into rate of interest. That's a formula. Now the final value being 15,000 into 5.5 multiplied by 12%. Come on, get the value. 9,900. Hope now you'll be able to understand this one. Clear? Now what happens here? C withdraws 20,000 every month, middle. It's in between. In case draw every month middle, what you can do? Draw every month middle. If drawing happens every month middle, 6.5 is for beginning, 5.5 is for the end. In the middle means it's a half of these two. 6.5 plus 5.5 divided by 2, 6. So the answer being monthly demand into 6 into rate of interest. Here monthly drawings 20,000 into 6 into rate of interest being 0.12. What is the final value? 14,400. See, I explained all these things in such a manner to make you understand the logic behind arriving this formula. You have to understand what is called product method, and direct calculation method, and formula method. Product method is nothing but whatever the amount you've drawn or got as a loan or invested in the bank, and multiplied with the period eligibility for interest. That period may be in terms of month or in terms of days. If it is being in terms of month, you can simply multiply with the month, you will get the total value. Hope you will be now able to understand this one. Clear? Any doubts here? Hope now you will be able to understand all these aspects. So in this case, every month beginning, the formula being monthly drawings, it's not total drawings, monthly drawings multiplied with 6.5 into rate of interest. Every month end, the formula being monthly drawings multiplied with 5.5 into rate of interest. and every month middle, then monthly drawings multiplied with 6 into rate of interest. Very simple, very simple. Clear? You apply this formula, that's more than enough for your examination, but logic is very important. That's why I have given all these inputs here. Now the fourth case, D withdraws 25,000, 30,000, 40,000 into three different dates. Then how can we calculate? We don't have the shortcut, so we can use either product method or direct method. Product method or direct method. Product method means the number of months or period eligible for interest calculation, and finally you can calculate interest based on the product value. In case of direct method, for each and every drawings you have to calculate interest separately. Is that okay? You have to understand the difference between product method as well as direct method. Let me now finish up the direct method first, and later I just resolve this using product method also. Now 1723 drawings being 25,000, and 311023 the drawings being 30,000, and 1124 the drawings being 40,000. Year ends on financial year, we assume it is ended on it ends on 31st March 24. Now number of months eligible for interest for the first case being 17 to this date. Come on, tell me how many months are there? 9 months. And from 31st October to 31st March, how many months are there? October over, so November, December, January, February, March, 5 months. Am I right? So this one is eligible for a 5 months interest, and for this how many months are there? January, February, March, so 3 months eligible. Now we can calculate interest under direct calculation method. How? 25,000 applicable rate of interest being 0.12 per annum, eligible for only 9 months, 9 by 12. This is called direct method. This is called direct method. Come on, tell me the value. How much? 25,000, 1% is 250, 9 month, okay, 2,000, okay, 2,250. And for this 30,000 into 12% for how many months? 5 months, 5 by 12. 1,500. Yes, come on, get me the final answer. 40,000 into 0.12 into how many months? 3 months, 3 by 12. 1,200. What is the final value? 9,000? 4,950. This is called direct method. Sir, can we solve under product method, sir? Yes, of course you can do the product method. How do we do? The product is nothing but the drawings in the month eligible for the interest calculation. If you multiply these two, then it is called product. 25,000 into 9, 2,25,000. 30,000 into 5, 1.5 lakhs. 40,000 into 3, 1,20,000. What's the total of product? 4,95,000. Now you have to calculate interest for this product. 12%. While calculating interest, now tell me, product is for month or days? The product is for month only, no? So you have to calculate interest for a month. This is for a year. For a month, you have to divide this by 12. So the final answer being 4,950. Calculating this way is called product method. Calculating the other way, the earlier way, is called a direct method. You need to understand both the methods to solve the illustrations. Clear? If you have any doubt, you can ask me, else we will move on to the next illustration. Shall I move to the next one? See, all these things you might have studied to your school days itself. But I am giving some conceptual background and the root of all this study. Okay. If it is clear, text me online students. We will move on to the next illustration. Before the break, I think I may finish off P&L appropriations and past adjustments. After the break, we'll start with the adjustments before we prepare admission retirement and admission retirement and all. So if I'm able to complete these things, the next class Sunday, I'll finish off admission, retirement, death, everything completely by next coming Sunday. Okay. Now, here drawings against capital. In case if the drawings being against capital, you have to subtract from the capital, balance capital is eligible for interest. Okay, drawings is separate, but here drawings is subtracted from the capital and then the balance capital is eligible for interest calculation. A, B and C are partners sharing profits and losses in the ratio of 3:4:5. Their capitals being this much in the year beginning. The profit for 23-24 being 2 lakhs, A introduced 1 lakh, 4 lakhs on this date as additional capital. Okay, so this is what about the A's capital. And this is B's capital. B introduced to 1 lakh and 2 lakhs additionally sometimes later. And this is C's initial capital. C withdrawn capital of rupees 2 lakhs. This is minus value. So A and B already contributed during the year, they further introduced additional capital. In case of C, he has initially 3 lakhs, later on he withdrew 2 lakhs from his capital, not from his profit. Now we can calculate the interest for all these three partners and rate of interest being 12%. Let's start with A. In case of A, initially 1,423, the capital being okay, capital being 1 lakh and another 1 lakh introduced on 1923, additional capital 1 lakh and again another 4 lakhs on 31/12/23. Okay, 31/12/23, additional capital 4 lakhs. Now what is the year end? 31st March 24 will be the year end. Come on, tell me number of months eligible for interest calculation for the first one. Maybe 12 months. Here from 1/9 onwards, 9, 10, 11, 12, so 7 months. Okay, and 31/12 onwards, 3 months. You can calculate interest for the 12 months for 1 lakh and 7 months for this another 1 lakh and 3 months. Okay, for the 4 lakhs you have to calculate interest for the 3 months. Okay, come on, find out the interest. How can you calculate? You have to multiply this into rate of interest per month. Rate of interest being 12% per annum. Then per month it should be 1% or 0.01. 10,000 into 12 into 0.01. What is the value? Make it faster. 12,000. Next one being 7,000. Next one being 12,000. Overall value being 31,000. Clear? We got this value. Okay. Next, in case of B, initially on which date? 1/4 for B. 1/4/23. He has 2 lakhs. Okay, he has 2 lakhs. balance. How much he has? 2 lakhs. Again, he introduced another 1 lakh, another 2 lakhs. This 1 lakh being on 1/4/24. This one being 31st March 24. Year end being 31st March 24. Now calculate interest. You can calculate the interest for the first one being 12 months. This one from here to here 1/1/24. No, this one is 1/1/24. Sorry. 1 lakh withdrawn on, sorry, additionally invested on 1/1/24. So from that date to the year end, only 3 months. And here 0 month. Here 0 month. You can calculate interest also. Okay. So amount invested month into rate of interest per month 0.01. 24,000 I think, and 3,000 0. So overall value being 27,000. Am I right? Some book the calculation may be pretty different also. How? So for the 2 lakhs 12 months interest, for 1 lakh 3 months interest, for the last 2 lakhs withdrawn at the last date carries no interest. Carries no interest. So the overall interest being 27,000. 27,000. Clear? Now, some others may recommend to show this way also. 2 lakhs. Thereafter, suddenly another 1 lakh introduced, his capital rises to 3 lakhs. Again, he invests another 2 lakhs, his capital rises to 5 lakhs. This is what about the adjusted capital in his own account as on the date of investment made further. Now, come on, tell me, this is what about capital available. Number of months eligible for interest. This 2 lakhs capital remains in his own account as capital from this date to this date. How many months are there? 1/4/23 to 1/1/24, 9 months. And thereafter, his capital increases from 2 lakhs to 3 lakhs by introducing another 1 lakh. So his capital balance will be 3 lakhs from how many days? From this date to this date, 3 months. Thereafter, further he invests another 2 lakhs, so his capital increases to 5 lakhs. The increased capital 5 lakhs remains in his capital only for 0 days. Now find out the interest here. Interest is nothing but capital into month into rate of interest applicable, in this case being 0.01. Yes, 18,000 I think. Hope this value being 18,000. In this case 9,000. Here 0. Now also you'll get the same 27,000 rupees. You'll get the same 27,000. N number of methods may be applicable for calculation of interest on capital and interest on drawings, and most of the books follow different approaches. Should not panic. You have to understand the logics here. Should not understand the logics here. Clear? 2 methods. In the very first method, we calculated interest for the actual contribution made. Next one is based on the change in the capital we calculated. Change in the capital we have calculated. Both the method you can follow. In case of C, actually his capital on 1/4/23 being 3 lakhs. Thereafter he withdrew 2 lakhs on this date. 1/2/24 minus 2 lakhs. Minus 2 lakhs. So we have to calculate interest for how many days? 31/3/24. So the capital balance in his book being 3 lakhs at the time of starting the year. 1st February he withdrew around 2 lakhs. Thereafter balance decreases to 1 lakh. Now 3 lakhs remains as capital in his books of account for how many months, sir? How many months? 1/4 to 1/2. 10 months he has capital of rupees 3 lakhs. Thereafter his capital decreased to 1 lakh for how many months? 2nd month and 3rd month, only for 2 months. Now find out the interest here. Multiply these two along with the interest rate. I think it is 30,000 rupees. For 1 lakh, 1% interest, 1,000 for 2 months, 2,000 rupees. Then overall interest payable to C in this case being 32,000. Hope now you'll be able to understand the interest on drawings as well as interest on capital calculations. And these contents I'm talking here, for the calculation of interest on capital, interest on drawings, all these things are very, very least important in your examination. Even you may expect only one-word questions or two-word questions. But the comprehensive illustration being the admission retirement, no, very often you can expect the illustration from there. But these aspects may be given as single adjustments in your questions. You have to be double cautious with that. You have to be double cautious. Come on, make note of it. Question number 3. Question number 3. A, B, and C are partners sharing profits and losses in the ratio of 3:2:1. Their capitals on 1/4/23 were 60, 40, 30. The profit for the year being 18,000 rupees. Appropriate the profits to the partners where the partner C is guaranteed for a minimum profit of 5,000 either by A or B or by the firm. See, normally what happens is the profit being 18,000, P&L ratio being 3:2:1 should be shared among all the three partners in that ratio. What's that? 3:2:1? 9,000, 6,000, 3,000. Hope now you'll be able to understand. Clear? 9, 6, and 3. Any doubts here? But here, C is guaranteed for a profit of 5,000 rupees. Some partners will join here demanding a guaranteed salary, means profit. So A requests C to invest and become the partner of the firm. C says, no sir, I don't want to take the risk. Whatever the amount I invest, no. Rather than investing in the partnership firm, I can invest in the bank, I can get decent income. Then A says, don't worry. Even though if there is a loss, I will guarantee to pay you 5,000 rupees. That is called guarantee. In this case, as per the P&L ratio, ABC will get 9,000, 6,000, 3,000. But what about the guarantee given to C? 5,000 rupees. As per the P&L ratio, now C gets only 3,000 rupees. Now you have to add another 2,000 rupees excess. Who has given the guarantee here? A, no. So B will not accept for the extra payment to C. As the guarantee is given by A, now you have to adjust that profit from A. So hereafter the profit and loss ratio being profit shared between among the three partners being 7,000, 6,000 and 5,000 and 5,000. Clear? Hope now you will be able to understand this one. If the guarantee is given by B, what happens? 9,000, 6,000, 3,000 is the P&L ratio as per the P&L ratio. But C is guaranteed with minimum how much? 2,000 rupees. Minimum 2,000 rupees. As the guarantee is given to C, he has to be given 5,000 only. Now, who has given this guarantee? In scenario B, B has given the guarantee. As B has given, I have to subtract the excess amount given to C from B. So now 9,000, 4,000 and 5,000. This is scenario B. This is scenario B. Hope now you'll be able to understand. Clear? Now what about the last scenario? If the guarantee is given by the firm, how can we calculate? As per the regular P&L ratio, A gets 6, B gets 6, A gets 9, B gets 6 and C gets 3. C gets 3. But the guarantee given by firm, a minimum profit of rupees 5,000 should be payable to C. So you now pay the 2,000 rupees to C. That 2,000 should be subtracted from A and B's profit. And in what ratio? Their P&L ratio. 3:2 ratio. Okay, 3:2. Leaving this. So this 2,000 is shared. The excess amount payable to C is shared by A and B by foregoing their own profit. 1,200 A leaves and 800 B leaves. Now 8,000, sorry, 7,800 is the profit for A and 5,200 is the profit for C and B, and C gets 5,000 rupees. Is that okay? This is what about the scenario C. This is called profit guarantee scenario. See here, while preparing the P&L appropriation account, some to make the sum complicated, there will be interest on drawings adjustment, interest on capital adjustment, and when the profit guarantee is given, how can we handle? So all these cases we have to understand. Clear? Hope now you'll be able to understand. Any doubts here? Clear? Any doubts here? So I have completed three aspects here. How can we adjust the or calculate the interest on drawings, interest on capital? In case of profit guaranteeing, how can we handle? And last case is all about commission. You might have again, of course, studied in your school days. What's that? 10% is commission on profit after charging or before charging such commissions. So those confusions are there now. So I'm going to highlight that part here in the fourth illustration. Shall I go for that? Clear? So case 3. Now the guarantee given to C being 5,000. There's a shortage 2,000. The guarantee is given by whom? Partnership firm. Partnership firm means A and B together given the guarantee. The rest of the two partners. And as per their own P&L ratio, it is guaranteed. Okay. So that's the reason this 2,000 will be now shared by A and B, the remaining two partners. That's called guaranteeing by the firm. Or here you can calculate the other way also. What is that other way? Other way, A, B and C. For C, whichever is higher of, one is his share, 18,000 multiplied by his share being 1/6, 3,000, and minimum guarantee, okay, 5,000. Between these two, whichever is higher will be payable. Overall profit being 18,000. So out of that 18,000, C should be given guarantee 5,000 or 1/6 share or guarantee, whichever is higher should be payable. Out of 18, 5,000 is paid and balance being 13,000 will be shared between A and B in their own rest of the P&L ratio. A will get 13,000 into 3 by 5 and B will get 13,000 into 2 by 5. Is that okay? This is another approach of solving the same. 3/5 of 13,000, how much is that? Are you getting 7,800? You'll get the same answer. Okay. Firm guaranteeing means, first of all, you have to pay the guaranteed partner. Balance left over will be shared with the continuing partner, remaining partners in their own ratio. 3:5, 3:2:1. Leave the guaranteed partners sharing ratio 1 share. So 3:2 is the ratio. You can share the remaining balance to these two using 3:2 ratio. Clear? I hope you will be able to now understand. Shall I move on to the next one? Now, A, B, and C are partners sharing profits equally. Their capitals are as on this date being this one. Salary is payable 10,000. Profit for the year being 50,000 rupees. Okay, B is entitled to commission of 10%. So we have been given three options. I may calculate all the three options. I will start with the first option. P&L appropriation by net profit. How much is the net profit? 50,000. And salary payable to C. How much is that? 10,000. Salary payable to C, 10,000. And B gets commission. How much is that? On net profit, 10%. So net profit being 50,000, on that 10% being 5,000 rupees. Balance being 35,000 shared among the three partners equally. Is that okay? Should be shared for A, B, C equally. Equal partners. Now, scenario 2. Net profit after all appropriation but before such commission. This is the scenario. By net profit 50 to C's salary 10,000 rupees. B's commission and net profit. Now, from the profit, you have to subtract what? You have to subtract what? All appropriation except B's commission. Except this one, you have to subtract all appropriation. Here, only one appropriation is there, which is nothing but salary. From the 50, you can subtract what? Salary, 10,000. Okay. I am not subtracted the commission. On this value, 10% will be given as a commission to the partner. What's that? 4,000 rupees. Balance 36,000 should be shared among the three partners. Scenario 2. Let's go for the scenario 3. P&L appropriation account. Scenario 3. By net profit 50,000. To C salary 10,000. Now B is entitled to a commission of 10% on net profit after all appropriation and such commission. Okay. So in this case, how can we calculate? Okay. So you have to subtract from the 50 C salary and B's commission. You have to subtract the B's commission also, but I am not aware about the B's commission. On that, 10% will be calculated. 10% should be calculated. Now, you can keep this working in short. 10% commission on net profit after all appropriation and commission, NPAC. If it is so, no, this numerator value represents the commission, denominator value represents the number after on. Is that clear? So net profit before commission, subtract the commission, finally you will get the net profit after commission. Clear? Net profit before commission minus commission, you will get net profit after commission. Among the three number, which number you know? If this commission being 10, Net profit after commission should be 100. Net profit before commission should be 110. Okay, from this logic. So commission is 10. Net profit after commission being 100. So I completed these two. From this 10 is subtracted to get this 100 means for the by the reverse calculation you will get net profit before commission as 110. If you are able to find out one of the three numbers, you can find out the rest using the cross multiplication. Which number you can calculate? You can subtract what? You can subtract salary from this. 50 minus 10, 40. What is this? This 40 is nothing but net profit before commission. We get this one. Okay. Net profit before commission in this case being 40. How? 50 being the net profit. Leaving the commission, I have to subtract all the expenses. Here, I have been given only one expenses other than the commission, which is salary. For 10,000 is subtracted. From 50, 10,000 is subtracted, then it is 40. And commission can be calculated using the cross multiplication. So 110 being 40 means what is the 10? 40,000 into 10 by 110. So usually in schools and even in text, in the net profit, if commission to be calculated after charging such commission, then you calculate this way: commission divided by 100 plus commission. That's how a formula is mugged up. Rather than mugging up the formula, you understand the logic. This logic will be used in most of the other cases, like calculate the net profit 10% on sales, 10% on cost. Such a way there is a confusion. So for that also you can use the same logic. Whatever the term may be, the numerator will be the first one. Numerator will be the first one. Denominator will be the term given after on. Okay, term given after on. That's a very, very important. If you are able to understand, then the calculation is very simple. So 10,000 to 10 by 110, what's the final value? Come on. 3,636. Balance being 36,364 is the net profit shared among the three partners. So from this, it is very clear. If you are supposed to calculate commission only on net profit, directly you can calculate 10% on net profit. Net profit, okay. And net profit after all appropriation before such commission means 10% into net profit minus all expenses, all appropriations. Except what? Commission. Except commission. In this case, 10 divided by 110 means commission divided by 100 plus commission into net profit minus all appropriation except which appropriation? Commission appropriation. So that's how we can simply mug up this so that you can finish up the calculation fast. Understand the logic and then try to solve the illustration a bit faster this way. Is that clear? Yes, come on, make note of it. Now let's move on to the next one. So one of the basic illustrations for understanding complete illustration. See, up to 5, no, it's a basic component. We have studied the comprehensive illustration question number 6. So here I am explaining you all the other things also in detail. That's all. Clear? Let's try to solve this illustration. Prepare P&L appropriation account and capital account. Come on, join with me to solve this illustration. It's pretty simple. Make it faster. Come on. Try it. Try it yourself. You can try the illustration yourself. So finish up solving this illustration and take a break. We'll resume after the break. So let me try it faster. I asked you to try it yourself. Let's cross verify this. A, B, and C are partners. So we have been given three partners: A, B, C, capital account. A, B, and C. Their P&L ratio being 3:2:1. On 1/4/23, their capital balances by balance. For A, 1 lakh. For B, 60,000. For C, 40,000. The profit for the year, P&L appropriation account. Net profit, 60,000. And drawings of these partners, drawings for A, B, C should be debited in capital account. So A, 10,000. Yeah, once again. So A, 10,000, B, 5,000, and C, 10,000. Appropriate the profits and losses to the partners. C is given salary of rupees 5,000. And commission 10% on profit payable to B. 10% on the profit. So profit being 60, 10% on this being 6,000. Interest on capital at the rate of 10% for A, B, C. On their capital, you have to calculate 10%. So for A, 10,000, B, 6,000, C, 4,000. Interest on drawings for A, B, C. You have to calculate only half year. So otherwise 6%. 600 for A, 300 for B, 600 for C. Then find out the profit and loss. There's a profit of rupees 3,500. So it should be shared among the three partners. A, B, C in the ratio of 3:2:1, 15:50, 10,167, 5,083. So all the debit side values are meant for the partners should be credited in their respective capital account, P&L appropriation account. Under that, for salary, A will be credited, C will be credited with 5,000. For commission, B is credited with 6,000. Interest on capital, A, B, C all will get 10,000, 6,000, and 4,000. Interest on drawings should be debited to the partner's capital account, P&L appropriation account. Interest on drawings, A 600, B 300, C 600. Now find out the closing balance of capital. Profit and loss ratio, 15,000, 250, okay, 10,167 and 5083. 1,25,250, 82,167, 5483. So here capital balance, balancing capital, 1,14,650, 76,867, 43,483. That's all. So here only the P&L appropriation account and capital accounts are important. Rest of the things may be included as an adjustment. So we have completed all these things. Now let's move on to the next aspects, past adjustments. Okay. So in practical problems, we have completed these two concepts. P&L appropriation, capital account, and calculation of interest on drawings, capital, treatment when the guarantee is given to the partners, minimum profit, commission payable to the partners. So all the four items separately we discussed with small illustrations. Now we'll start with past adjustments, rectification of errors as well as change in details. Clear? You have to try lots of illustration on past adjustments content so that your understanding level will improve. Right. Now come on. Try to solve this one now here. A and B started a partnership on 1/1/23 with the respective capital contributions of 1,20,000 and 40. Their capital balance as on the year end being this much. This is opening capital. This is closing capital. The transactions recorded in the capital accounts during these 2 years were interest on capital 10% per annum on initial investment and allocations of the income. So two things were added. Opening capital becomes 2,09,500 and 90,500 for A and B by the end of second year. The change due to two reasons. One is interest on capital as well as profit sharing. On 31st December 24, it was further discovered that drawings of 42,000 by A and B had been wrongly treated as business expenses. So error. A's drawings and B's drawings are considered as business expenses, means it might have been debited to the P&L account. Drawings should be subtracted from the capital account. No, what is the entry for the drawings? Drawings account debit to bank. What they have done? Expenses to bank. This is called error of principle. So now you have to rectify. The error happened in the previous years. Now we have to rectify this. You are required to pass single entry to adjust the partner's capital account correctly. So let's see. On 1/1/23, the capital of A as well as capital of B, how much was there? Started with 1,20,000 as well as 40,000. And during the 2 years period, interest is added, interest on capital, and profit and loss account also adjusted. Profit is added, loss is adjusted. The ultimate value is nothing but the closing capital by the end of second year, 31st December 2024. From January 1, 2023 to December 23, 1 year, December 24, another year, so 2 years information. On 1/1/2023, 1,20,000 and 40 contributed opening capital, and closing capital by the end of second year, 2,09,500 for A as well as 90,500 for B. So only two items were added here. One is the interest on capital over the 2 years period and allocated profits. Allocated profit is the wrong one, not correct one. The wrong profit was allocated to these two partners because the 42 and 30,000 should be subtracted from the capital account. No, they have debited to the P&L account wrongly. So that should be done later on. Now, I am going to calculate what they have done wrongly first. Then thereafter I will calculate what should be done correctly. Then compare the difference and go for the rectification. So interest on capital is payable at the rate of 10% per annum on initial investment for the 2 years. So 1,20,000, 10% means 12,000 per year. For 2 years, 24,000 rupees may be given. For B, 4,000 for the 2 years, 8,000 may be given. 8,000 may be given. The capital becomes 120 plus 124, 1,44,000 will be A's capital after interest and B's capital being 48,000 after interest. Yet the balance being 2,09,500 means definitely it should be the profit earned and added to A's and B's account. Come on, how much is that? The difference between these two balancing figure. How much? 65,500. For B, 42,500. Yes, come on, tell me the total value of the firm. Firm's value. Initially 1,60,000 and 32,000 is the interest on capital. 1,92,000 and profit being 1,08,000. Closing balance of the capital of the firm being 3 lakhs. Now, what is the profit they have earned? 1,40,000. 1,40,000. 1,40,000 will be the profit. Is that okay? 1,40,000 will be the profit. Any doubts here? 32 plus 1,08,000, 1,40,000 will be the profit component. Now the question is it correct one or wrong one? It's a wrong one. Okay. Profit and loss for year 23 and 24 being 1,40,000. This one is error. This one is error. Now they have wrongly debited these two in the P&L account. If it is not debited to the P&L account, what could be the correct profit? The correct profit will be higher. As they have debited 42 and 30 in the P&L account, the profit might have been lesser. Now I am going to add these two. Add drawings of A and B. Drawings of A and B. 42 plus 30, 72,000. 72,000. Clear? Drawings of A and B. If I add, then this value being 2,12,000. This is what about the profit and loss for the year 23 and 24. Otherwise, correct one. This one is correct one. Okay, correct one. Is that okay? Now, appropriate this one. Appropriate this one to the partners. So, for the appropriation, right. 1,123 A, B and total. What about their capital? 1,20,000, 40,000, 1,60,000. Add that interest component with this. How much is the interest? 24 and 8,000. There is no any problem here. 36,000 is the interest. 32,000. Okay. Clear? We got this interest. Now, out of 2,12,000, 32,000 is for interest. Balance being profit and loss. How much is that? 1,80,000. How can you distribute or appropriate the profits earned? 212 will be shared to the partners for interest on capital, salary, commission, if any. But we have been given only interest on capital. I subtracted interest on capital. After subtracting the interest on capital, whatever the amount left over, that 180 is called the profit and loss. Will be shared between these two partners as per the ratio accepted. If the ratio is missing, then you have to share equally. So the ratio is missing, then the profit will be shared equally. 90 is for A, another 90 is for B. The value being 1,80,000. 1,80,000. So then what happens? The drawings debited to the P&L account wrongly is now reversed. So as we have reversed this, the profit is increased to be distributed to the partners based on the correct one. We have done that. And where it should be adjusted now? The drawing should be subtracted from the capital account. We have to debit to the capital account, right? So minus drawings. How much is drawn by A? 42,000. The 42,000 should be subtracted from A's capital. 30,000 should be subtracted from B's capital. Overall value being 72,000 should be subtracted. Now, what is the ultimate correct balance? 31, 12, 24. What is the correct balance? Come on. Get me the value. Make it faster. For A, I think it is 1,92,000. Am I right? For B, 1,08,000. What is the firm's total profit? That firm's total profit remains the same, 3 lakhs. The firm's total profit, 3 lakhs remains as it is. Separated for A and B, 1,98,000 and 1,08,000 rupees. Separated. 1,98,200 and 1,08,000. Is that clear? Clear? Hope you will be able to now understand. 1,92,000, 1,00,000. Here also the same. 3 lakhs. But as per the correct calculation, A should have only 1,92,000, right? So, from this it is very clear, because of the wrong calculation, A's capital is higher and B's capital should be 1,08,000, his capital is lower. Now, what happens here? B will be unhappy, A will be happy. Because of the error, A gets happy. Now, the error to be rectified. So, ask A to return the money and the returned money will be given to whom? To B. How much A has to return? 17,500 is returned and that 17,500 is given to B. So, for B it is addable, for A it is subtracted. For B it is addable means B account should be credited. By crediting, his capital will increase. A's capital shows 2,09,500. I am going to charge him means I am going to debit him. Debiting the A's capital will reduce his capital balance. After passing this adjustment entry, the capital of A and B will be as per the requirement, as per the correct one. Is that clear? This is called rectification of errors. Past data is going to be adjusted. It's nothing but rectification of errors only. At your professional level, most probably you may expect similar types of illustration rather than directly calculations of P&L appropriation. That's elementary level. Only these kinds of some creative illustrations may be asked in your exams, right? Come on, make a note of it. Those who have studied a CBSE syllabus in your school days, this may also be one of the content. Okay, past adjustment. But in state board, we don't have past adjustments in our study. Clear? Come on, make a note of it. If it is clear, text me. Online students, keep texting me. Come on, make it faster. So wrong calculation, right calculations, and find the difference, and that difference is adjusted. That's all. So in case of rectification of entry, error entry, how do you pass? Pass the correct entry, pass the wrong entry. Reverse the wrong entry and combine with the correct entry to get the rectification of error entry. The same happens here. Okay, rectification of errors like. Now, Ram and Rahim agreed to share profits as follows: 8,000 to Ram and balance in 2:1. PSR, profit sharing ratio. Okay, up to 8,000 is given only to Ram. Balance, if any, will be shared between Ram and Rahim in the ratio of 2:1. I just one information one is available. Profits for the year being 11,600. The capitals being Ram 40, Rahim 36,000. Interest on capital had been omitted from the books and is to be allowed at the rate of 5% per annum. Okay. So what happens, net profit being 11,600. From this, what you have to do as per the correct calculation? First, you have to pay the interest on capital. For the balance, you have to treat as per the PSR. This will be as per the PSR. Now, what they have done? Okay. The entire 11,600 net profit, forgotten to distribute for appropriate for the interest on capital. Directly they applied the PSR for sharing this to Ram and Rahim. This 11,600 considered as ultimate profit distributed to the partners Ram and Rahim as per the PSR for Ram and for Rahim. For Ram and for Rahim. As the overall value being 11,600, okay, first part, second part. First part is directly given only to Ram. The excess amount other than 8,000 will be shared between Ram and Rahim in 2:1 ratio. 2,400 is for Ram and 1,200 for Rahim. They shared like this one: 10,400 for Ram, 1,200 for Rahim. Now the question is it correct? It is not correct one. It's a wrong. Why? They have missed to adjust what? Interest on capital is missed to be adjusted. That's a wrong. Because of this wrong one, the capital may be totally different. Now you have to find out what could be the correct one. So this is how amount is credited to their concern account. Then what is the correct one? Net profit being 11,600. First you have to offer for their interest commitment. Ram and Rahim. Ram and Rahim. Ram's capital being 40,000, for that 5% being 2,000. Rahim capital 36,000, for that 5% being 1,800. 1,800. Balance being profit and loss. After sharing the interest on capital 3,800, the leftover amount, how much is that? Come on. Is it 7,800? The balance 7,800 is shared as per the PSR, profit sharing ratio. Clear? Out of the total net profit, first offer the interest on capital. After payment of interest on capital, leftover will be shared among the partners as per the PSR. So after the interest on capital, the leftover amount being 7,800, PSR says up to 8,000, it is meant only for Ram. Now the leftover profit is less than 8,000, so the available entire amount is for Ram only, not for Rahim. Is that clear? Hope now you'll be able to understand how we can share this. This should be the correct one, but this is the wrong one. As per the correct one, Ram will get 9,800, Rahim will get 1,800. But in this case, Ram got more than what he deserves for, Rahim gets less than what is eligible for. So, as Ram got more, now we have to ask him to return that money. How much he has to return? 600 should be returned from Ram, otherwise it is going to be debited to Ram's account. Returning means I am charging him, debiting. The amount returned by Ram is given to whom? Rahim. So the difference between these two. Then what is the ultimate entry? Ram's capital account debit 600 to Rahim's capital 600. Ram is debited, Rahim is credited. That error, due to the error, some partner gets more, other partner may be lost. So that now that will be adjusted because of rectifying this one. Clear? Clear? Okay. Yes, make a note of it. Since the morning, how many illustrations we have completed? Only 2. Originally, I teach this illustration. 8th one means 6th one and 7th one. All others are to make you understand. I have added some extra, not required for your examination. Do I want to learn? Definitely want to learn. A comprehensive illustration will have small part like an adjustment regarding those things we have learned. Right. So you have to learn all. So I have covered only 2 things. What are they? P&L appropriation and cost adjustments. Don't say, sir, 8th sum, sir. It's only 2. It's only 2. Then you will say, sir, since the morning you are teaching only 2 illustrations, sir. Okay. Understand the concepts. Understand the concepts. Clear? Text me once it is over. Ninth question, one of the comprehensive illustrations. Though it is P&L appropriation account, but ninth question is typical. Okay, you need to understand a lot of logics and all, and takes time to solve in your examination. You can solve, but it takes time. Online students, come and text me to move on to the next illustration. Now, A, B, C, and D are partners in garage comprising petrol sales, repairs and servicing, second hand car dealing. So 3 divisions are there. Okay, what are they? Petrol sales, 1 division. Repairs and servicing, another division. Second hand car, another division. And who is in charge? A is responsible for petrol, B is for RS, C for second hand. So each and every partner will be responsible for every division. And one more partner is there, D, who takes care of the entire organization as an advisory. Okay. The partners agreement provides for the following. Each partner is to receive commission of the net profits of the partner's own department as under commission from their department. commission from their department. Okay. A gets the commission from the net profit earned by running the petrol sales. B gets the commission from repairs and servicing department's profit. C gets the commission from second-hand sales. So A's commission in this case being 10%, B gets 15%, and C gets 20%. A total salary of 11,000 is payable to D, which is to be allocated among the above three departments in the ratio of 3:4 respectively. And salary payable to D, as he renders an advisory job, yet he demands some salary. The salary payable being 11,000 rupees now, in whose department's profit will be meant for this one and where it is going to be charged. So based on the devoted time, there are some other reason or some other basis. The salary payable to D is allocated to these three departments in the ratio of 3:4. Overall 11,000. We assume out of that overall value, 3 part out of 11 is for PS department, 4 part for RS department, another 4 part is for second-hand department. 50% of the net profit of each department after charging commission and salary will be distributed to A, B, and C as under. Okay, 50% of the net profit of each department after charging commission and salary. Or whatever the profit they have. Net profit after salary and commission. Whatever it may be, in that 50% will be shared equally. A, B, C equally. The profit from the petrol sales department, 50% will be shared among A, B and C equally. Repairs and servicing also be shared among the three partners, 2:2:1 ratio, and second hand 3:2:1 ratio. The balance of the profit of the firm will be shared equally. Balance, if any, will be shared equally. Equally means 4 partners are there. A, B, C, D. 4 partners are there. All the 4 partners will share equally. Okay. Now, what happens here? Profits for the year ended were as under. Now, profit. PS, RS, second hand. Profit and loss. How much is that? For 20, 40 and 50. 20,000 for PS department profit, 40,000 for RS department profit, 50,000 for second hand department profit. The partners capital given and interest on capital being 10%. Interest on capital. Now, find out the interest on capital. Interest on capital. 4,000, 3,000, 2,500 and 1,000. This is what about the interest on capital. Interest on capital. I am going to appropriate this one. Appropriate this one for commission. 10% of the concerned department's commission. Okay, commission. For A, for B, for C. A gets 10% commission from where? His department, 2,000. B gets 10% from RS department, 15%. 15% on 40, 6,000. C gets 20% on his department profit, 10,000. And salary payable. Salary payable. Okay. Is for whom? For D. How much is that? Overall 11,000. Any of that 11,000 is charged to these 3 departments. After that, whatever the amount left over, balance amount. How much is that? Balance amount. Or net profit after salary and commission. 15,000 and 30,000 and 34,000. Is that okay? Okay, 36,000. Clear? So there is no any format here. You read the question, understand the question, try to break the answers. Balance being 15, 30 and 36. In this, 50% will be shared among the 3 partners. Okay. For A, B, C, 7,500, 15,000, 18,000. What's the overall value total? What's the total we have? 15 plus 30 plus 36, 81,000. Out of that, 40,500 is shared among the 3 partners. Balance, how much we have? 40,500. Clear? In that balance, okay. You have to subtract what? Interest on capital. 3,500 plus 1,000 for A, B, C, D. 4,000, 3,000, 2,500, 1,000. What is the total value? 10,500. Am I right? Balance, how much I have? 30,000. This 30,000 will be shared among the other partners. Balance. See, whatever the net profit for every division after the salary and commission, 50% for all the 3 partners. Balance 50% you have no. From that, interest on capital is subtracted. Any leftover will be shared among all the 4 partners equally. 1:1:1:1. Clear? This will be shared in the ratio of 1:1:1. This will be shared in the ratio of 2:2:1. This will be shared in the ratio of 3:2:1. Now, I will calculate the overall capital of the partners. Overall the capital. What's their capital in the beginning? 40, 30, 25 and 10. Capital in the beginning. Opening. A, B, C, D. 40,000, 30,000, 25,000 and 10,000. Now what they get? They get commission. A gets 2,000 commission, B gets 6,000 commission, C gets 10,000 commission, D gets nothing. Salary. Salary is payable only to whom? D. What D gets? He gets around 11,000 salary. What about A, B and C? They get commission from their respective department's profit. So we calculated and added the commission. We calculated the salary and added to D. Only he is eligible. Apart from that, profit. Okay, profit or loss. Divisional profit and loss, first of all. For the PS department, the profit being 7,500 should be equally shared. A gets 2,500, B gets 2,500, C gets 2,500. Of course, nothing is for D. For RS department, the profit 15 will be shared among the three partners in the ratio of 2:2:1. So, what's the value? 6,000, 6,000, 3,000. Nothing for D. And second hand card dealing, 18,000 will be shared in the ratio of 3:2:1. So, 9,000 for A, 6,000 for B, and 3,000 for C. Apart from that, they are getting interest on capital. How much is the interest on capital? 4,000 for A, 3,000 for B, 2,500 for C, 1,000 for D. After all these appropriation, leftover company's overall profit due to the three departments, after all the appropriations, the leftover profit being 30 will be shared among all the partners. Firm's ultimate profit shared equally. 7,500 for A, 7,500 for B, and 7,500 for C, and another 7,500 for D. That's how you can now appropriate the profit. So, whatever the things you learned in your elementary level or school days, it's only a format, pre-format. In practical now, life it's not formatted one. Every customer, every partner may demand his own rights or his own profit. So he says, I'm taking care of A division, so I need to get a commission as well as a share from that. Common administrator will get common income also. So in this case, we don't have the structure. Prepare the P&L appropriation account and capital account as a format. No, we don't have the format here. You have to guess and get the answer based on the question. So read the question. Once you understand the question, half problem is solved. So if you are not able to understand the question, then solving will also be trouble. So you need to put more attention in solving that illustration by understanding. Read more illustrations. Try to read more illustrations, then you will be able to break and answer the questions easily. Clear? Come on, text me if it is clear. We'll move on to the next content. Make it note of it. So in partnership, I started with what? Introduction. In introduction, you have to understand the preparation of P&L appropriation along with two types of capital account, two methods of maintenance of capital account, and past adjustment. Okay. Second part is all about reconstitution of partnership firm, admission, retirement. One partner is admitted and another partner is retiring. Death of a partner. This is the second set. Reconstitution of firm. Hope you are clear with the first component. Even advanced illustration also we have discussed. We started with the concepts and then we moved with the advanced illustration. At the time of admission or retirement, you are going to reconstitute the firm, right? So before you go and solve the illustrations related to the admission retirement, you need to understand some adjustments. So before you master yourself final accounts of company or final accounts of any sole trade business, you need to understand the adjustments, right? Closing stock adjustments, outstanding advance. If you are master with those adjustments, of course, final accounts may be pretty simple. Similarly here, if you want to be master with this, you have to finish up some adjustments. What is that? First of all, you have to adjust the PSR, profit sharing ratio. As a new partner joins, it demands what's my share. So you have to calculate what is the new P&L ratio applicable for all the partners, PSR. Second one being, at the time of admission, existing partners could have earned money and without distributing, it may be kept in the balance sheet as liability side. Is that okay? In balance sheet. Usually what we do, whatever the profit we earned by running the business is shared among the partners. Sometimes the partners will say, don't distribute this. Keep the 0.5 lakhs in reserves and surplus account, reserve fund account. For the future requirement, don't touch my capital. We can adjust the future's requirement using the reserves fund. That's how they can keep some profit away without distributing. At the time of admission, what happens? If you don't do adjustments, sometimes later he demands, sir, there's an accumulated profit, my share you have to give me. So I have to tell him the profit what we have kept here is for us only, we have not distributed. We thought it may be used for the later period. As we are admitting, you are eligible for sharing the profit, only the profit earned hereafter. This is the profit earned before your admission, so it is going to be added with the capital. Understand the logic? So admitting partner demands some share. So now we have to calculate the PSR including his own share of profit. Second, whatever the profit we earned remains undistributed at the time of admission, close it to distribute to the old partners. So any resource surplus or reserve fund should be given to the old partners and usually shared in the old ratio, so that the new partner will not demand. He is not having the rights. Third one being assets and liabilities appearing in the balance sheet, say land and building, maybe 50,000 rupees. Purchased in 1995, almost 30 years ago. And you know that we usually record the balance sheet assets in our balance sheet at historical cost. Okay, historical cost means the actual cost you paid at the time of acquisition. So 30 years ago, you purchased the land and building for 50,000 and continue to appear at its own original cost of purchase. The land gets appreciated. Today, the value of the 50,000 worth land and building may be 5 lakhs. You understand? So if you don't revise the assets and liabilities value as on the date of admission, the incoming partner demands to settle his own capital based on the existing value. Sir, your asset is only 50,000. As I am going to join for 1/3 share, equal share, will I be able to pay only 16,000 rupees? Now, how will it be possible? The asset purchased almost 30 years ago. By the time the value of the money is very higher. Okay, you understand? So I can recalculate this value from 50 to 5 lakhs. That inflated value I will show to the incoming partner, and that inflated value is added to my capital. This is due to our own investment earlier period. So the existing partner says, sir, my capital is not 1 lakh. After this revaluation, my capital is 5.5 lakhs. Based on the 5.5 lakhs of investment, I demand your share to be invested, not with the old values. So you have to do revaluation of assets and liabilities. Revaluation of assets and liabilities. Third step. Clear. And a new company usually will have least fame in the market. Okay. So you usually see company A is there. Okay, a restaurant. Restaurant A is open, newly open, inaugurated in a great manner, and invited you to join for a very discounted price, or currently 1 rupee biryani like. So a queue is there and totally dissatisfied in the day itself. What happens? Will you go there in the next time? Usually will not go. And company B, where you will regularly go for a longer period, almost 10 to 15 years, you visit there with your family. A day, the taste is not up to your mark. You are not satisfied. What happens then? Will you go the same shop again? Absolutely you want to go there again, because you had good experience for more than 10 years. Once a while, it may go wrong also. That wrong will not spoil your intention to go there. And then the seller also knows you better. This customer visits us for more than 10 to 15 years. This time, if the customer complains, and he will take the steps to resort and waiver the fee and whatever it may be, fair and whatever it may be. That's how there is a good bondage. A renowned old business will have good reputation, and it has more earnability. One time earnability, thereafter there is no chance to earn. Here, even though the food is not tasty, yet the customers will visit again because of the previous year's experiences. Okay, inviting the customers again and again, it's a big task. Unless the customers coming there again and again, profit will not be there. Again and again, the customer coming there means only because of the reputations the old partners built in the earlier period. Because of their reputation, this company's earnability is better than newly started company. For the higher earnability, I need to get some extra revenue or extra fund. That will be named as goodwill. So you have to understand how to handle the case of goodwill. So calculation of PSR, distribute the accumulated profits and losses, and do the revaluation of all the assets and liabilities as on the date of admission and goodwill. And after all these things, you now admit the incoming partner and demand the capital to be contributed. So you have to understand the method of contribution of capital. Okay, these are the 5 predominant adjustments you have to understand. 5 predominant adjustments. Okay, apart from that, you need to understand joint life policy as well as individual life policy. Sometimes applicable only in case of death or retirement. Only in the case of death, Section 37 will be applicable along with the settlement of loan. Settlement of loan. These two will also be learned related to retirement case predominantly. Okay, Section 37 and the repayment of loan. The partner once he retired, no, the capital of the partner no more the capital because he already retired. The capital hereafter becomes the loan. Then loan may be immediately paid sometimes, but may not be possible to release the capital invested in the business. So usually there is a chance to settle this in over the period, due course, probably 3 or 4 years together with interest. The last two aspects predominantly applicable in the case of death or retirement cases. So in case of reconstitution of firm related to the admission, retirement, admission, retirement, death, whatever it may be, 5 points you have to be careful. One is PSR, next one is distribute the accumulated profits and losses, and next one is the revaluation of assets and liabilities on the date of admission, and fourth one is the company's credibility, valued in terms of money named as goodwill. Finally, how can we ask the incoming partner to bring the capital, a fund for his own contributions, right? These are the 5 aspects. And of course, JLP and Section 37. So, at the time of admission, reconstitution of firm, retirement, admission come retirement, death. Even altering the P&L ratio also be applicable here. Alteration of P&L ratio. So, what are the things you have to understand? New P&L ratio, distribution of accumulated profits and losses, goodwill, revaluation of assets and liabilities, and capital adjustments. These are the 5 predominant. And joint life policy, individual life policy in Section 37, you have to understand, especially for the retirement and death case. And reserves are being 4 natures: general, capital, specific, and secret reserves. So we'll see that later on. Okay. Now let's start with the calculation of new P&L ratio. PSR will finish, then we'll go for the goodwill. Once the PSR and goodwill calculation is over, majority concepts are over. Like then we can directly go for the comprehensive illustration, right? Yes, come on. We'll start with the first illustration for PSR. Can you try it yourself? Come on. You might have learned. No, you can try. I'll give you a summary like that. First question. A and B share profits and losses in the ratio of 1:3. C is joined for 1/8 share. Calculate the new P&L ratio. How can we solve this? So in this type, where the new partner's share is given without any information regarding how it is shared or how it is received from the old partners, and new ratio also not given, then this will be considered as type 1 ratios. Like, okay, new ratio not given, okay, new ratio not given, new partners ratio, okay, may be given, but how he gets may not be given, and how other partners sacrifice may not be given. This is a type 1. Up to now, we share the profits and losses in the ratio of 4:3. C is admitted and he is asked for 1/8 share. What happens then? If we earn 800 rupees, 1/8 for him, offer 1/8, balance 700 will be shared by A and B in their own old ratio. In this type, old ratio of old partners is equal to new ratio of old partners being C. Let's see in this case. Let the profit be 1. Let the profit be 1. First, you pay it to the incoming partner 1/8. After payment, what is the amount you left with? Will be shared by the old partners their ratio. So balance after C's share 1 minus 1/8. 7/8 is the balance. In this balance, A and B will be sharing in the ratio 4:3. So A's new ratio is equal to what are the amount left over with after the payment of C 7/8, where A gets 4/7. 4/8 will be the answer. Similarly, in case of C 7/8 and his old ratio being 3/7, 7/7 gets cancelled, so 3/8. So the new ratio in this case being for A, B and C. For A 4/8, for B 3/8, for C it's already given 1/8. If the denominator is same, just write the numerator alone as ratio 4:3:1. That's what about the new ratio. 4:3:1. Clear? 4:3:1. Any doubts? The main thing you have to note here is new partners ratio is given. How he gets from other partner and how other partner sacrificing, this is not given here. Clear? Old ratio of the old partners 4:3 and new ratio of the old partners. These are the old partners. The new ratio of the old partners is also 4:3. New partners old ratio as well as old ratio of the new means the existing partners being the same. New ratio of the old partners as well as old ratio being same. This is the first type. Clear? Now, very interesting one. What's that? If the ratio being the first type, 4:3, if the incoming partner share is 1/8 means put that one directly here. Do the summation. If the summation is equal to the denominator, then this is the final answer. So simple, right? Okay. So all the things what we have learned here, in case of first type, you can very easily get this answer. 4:3:1. But provided the total of this should be equal to the denominator. Otherwise, you have to do slight adjustment. Okay, you can get the answer and try to solve this in steps, because steps carries the mark in your examination. Don't write this way directly, 4:3. But you know the answer. Okay, but you need to prove this step, okay, with the step. Type 1. Okay, clear. Shall I move on to the next one? Now here, A and B share profits and losses in the ratio of 4:3. C joined for 1/8. After C's admission, A and B share profits and losses in the ratio of 3:4. Now what happens, they admitted C. After admission, whatever the amount left over, shared by A and B in their old ratio 4:3, but here it's not so. They shared the leftover amount in a new ratio 3:4. Then what could be the answer? 3:4 and incoming partner's value being 1/8. If I add, then it is 8. So answer is correct. Anyhow, you have to follow the steps. Let the profit be 1 balance after C's share. 1 minus 1/8 will be given. So 7/8. From the 7/8, A's new ratio. Whatever the balance left over after sacrificing for C, 7/8 we have. In that, A takes 3/7, not 4/7. 4/7 was the old ratio. After the admission, A says, I don't want to take 4/7, I will take only 3/7. So into 3/7. So the ultimate value being 3/8. Similarly for B, 7/8 into here 4/7. 4/8. So the ultimate ratio being 3/8 is to 4/8 is to the new partner ratio being 1/8. If the denominators are same, then directly write only the numerator to represent the short form of the ratios. 3:4:1. 3:4:1. Make it faster. Shall I move on to the third one? The copy. Online students, come on, text me. So I'm getting message from Gayatri and Srimati. What about the others? Okay. Darshika. Niranjana. Okay. Now, A and B share profits and losses in the ratio of 4:3. C is admitted as a new partner. A sacrifices 1/2 of his share to C. B sacrifices 1/3 of his share to C. Very interesting, right? 4:3 for A and B. Otherwise, 4/7 for A and 3/7 for B. The new partner C is admitted. What C gets? A sacrifices half of his share of profit for C. Okay, half of his share. His share being 4/7. In that 4/7, half is given. Originally, A has 4/7. In that 4/7, half is given, so you have to subtract this. Balance will be for C. Similarly, B says, I will pay 1/3 of my share. 1/3. his share being 3/7. So B's share in that 1/3 is calculated. That is going to be given to C. From 3/7, you have to offer this, so you have to subtract this value will be balancing value. Okay, balancing value. Okay, okay. Come on. In case of A, half of 4/7 being 4/14, and here 3/21. Am I right? 3/21. What C will get? 4/14, 3/21 will be the amount for C. What C will get? What A gives, what B gives. That will be the total value for C. So in this case, new partner ratio is nothing but the old partners sacrificing amount. What old partners are giving, that's what about the C's new ratio. A says, from my existing profit, half will be given. B says, from my existing one third will be given. One third will be given. What A gives, what B gives, you just add. That is what about C's share. So what happens here? 21, 21, or can I make it 28 so that it will be comfortable to calculate? Yeah, take the LCM. I can simplify this one. This is 2/7. This is 1/7. Am I right? So now the calculation is pretty simple. 2/7 plus 1/7, 3/7. Now what about the A? 4/7. He offered 2/7. Then finally 2/7 will be A's new ratio. What about C? 3/7, and what he offered, 1/7 is offered. So what is the ultimate value? 2/7. So this one is for C. Now the new ratio being A, B, C. A case 2/7, B case 2/7, C case 3/7, where the denominators are common. So 2:3 is the final answer. Or you can write this way. Okay, for A, old ratio minus sacrificing ratio. A, old ratio being 4/7, what he sacrifices from the old ratio, 1/2 is sacrificed. That's how you can write. This is what about the new ratio. New ratio is equal to the old ratio minus sacrificing ratio, what he offered to the others. In case of B, the same way, 3/7, what he sacrifices in his own ratio, 1/3 is sacrificed. Okay, so it's a professional way of writing. And in case of C, what he gets, sacrificing ratio of A as well as sacrificing ratio of B. A also gives and B also gives. What A gives, 4/7, out of that 1/2 is given. And in case of B, 3/7 his share, in that 1/3 is given. So the final value being 3/7. Hope you will be now able to understand. Here, new partners ratio is not given, but how old partners are offering is given. What A offers, what B offers, you add up that will be the new partners value. Clear? Clear? This is the second time. This is the second time. Now let's move on to the next one. Question number 4. Babu, Dabu are partners sharing profits and losses in the ratio of 3:2. B and D, their P&L ratio being 3:2. They admit Kachari for 1/6 share of profits in the firms. So now they admit K, what he gets, 1/6. Incoming partners sharing value also given, of which she takes 2/3 from Babu, 2/3 from Babu, and 1/3 from Dabu. So K's value 1/6, you know. K says I need 1/6. If your company's profit, firm's profit is 6 lakhs, I need to be given 1 lakh. How he gets out of that 1 lakh? 2/3 from B, 60,000 from B, 66,000 something, 33,000 from Dabu. So in my ratio, 2/3 I will get it from B. Okay, and in my ratio, 1/3 I will get it from D. This will be 2/18. This will be 1/18. Remember that 2/18 and 1/18, if you add, you will get what value? You will get what value? K's ratio you will be getting. If you add B's value as well as D's value, you will be getting K's value. 2/18, 1/18 is equal to 3/18 or 1/6. Sometimes if you add, it will be equal to 1. There the calculation is pretty different. Let's see. You have to understand the two differences. K says I need to get 1/6 of the firm's profit. And who has to give? Sir, out of my return, 2/18 B has to pay and D has to pay 1/18. Now what about the B's new ratio? New ratio is equal to old ratio minus sacrificing ratio. For Babu, old ratio being 3/5 minus what he sacrifices, whatever the C's profit and loss ratio, no, in that 2/3 is given, which is equal to 2/18. So 3/5 minus 2/18, take the LCM, 90 I think, 34, 54, am I right? 54 minus 10, so final answer being 44/90. 44/90. Similarly for D, 2/5 minus his sacrificing value being 1/18. 2/5 minus 1/18, otherwise you can take the LCM being 90. Okay. 36 minus 5, 31/90. What about incoming partner K, Kachari's sharing ratio? It remains the same. Already it is clearly given. No need to do any more adjustments. B, D and K, 44/90, 31/90, and his ratio being 1/6. If the denominator is not same, you have to make the denominator equivalent to other number. So as it is 90, it is 6 To make the 6 to 90, you have to multiply with 15. 90 by 6, 15. If you multiply the denominator with 15, do the same with the numerator also. So then this value being 15 bar 90. Now the denominators are same. If the denominator is same, you can write only the numerator. 44 is to 31 is to 15 is the new ratio. Is the new ratio. Is that clear? Clear? Text me. Now we'll move on to the next one. S and N are partners sharing profits and losses in the ratio of 5:3. They admit J into partnership for 3/10 of the profit or loss. So S and N are the partners. Their P&L ratio being 5:3. Okay, they admitted J, and for whom the profit shared being 3/10 of the firm. 3/10 of the firm's profit, in which J acquired 1/5 share from S and 1/10 from N. 1/5 from S, 1/10 from N. In the previous case, 2/3 from B, 1/3 from D, like given, right? If you add the 2/3 and 1/3, this is equivalent to one number. Am I right? If the amount or the profit he gets from B and D and ratio is also given, if the summed up value is 1, then from 1/6 multiply and then you subtract. Multiply and subtract. But here 1/5 and 1/10, if you sum this, will you be getting 1 or not? You don't get 1. 1/5 plus 1/10 is equal to, take the LCM, 3/10. If you sum, that value is equal to the incoming partner's share. Earlier it is not so. 2/3 plus 1/3 is equal to 3/3 or 1. If the information given that he gets from other partners in the ratio of 2/3 or 1/3, if you sum up those values, if it is equal to 1, the sacrificing ratio in this case is equal to new partners new ratio is multiplied with this new ratio given, with this ratios given. In this case, this 1/5 and 1/10 itself is the sacrificing ratio. These two concepts only most of the students getting confused. So incoming partners ratio is given. How he gets it from the old partners also given. But how he gets from the old partners, there is a ratio. If these two ratios are summed up, if the summed up value is equal to 1 or new partners ratio. Clear? Now, new partners, new ratio is given, and gets from old partners. Ratio is given. Okay. If the ratio's total being 1, then your sacrificing ratio is equal to new partners new ratio is multiplied with this ratio. This will be the sacrificing ratio. Gets from the old partners where ratio is given. If the ratio is total, which is equal to new partners new ratio, then what he gets as a new ratio itself is the sacrificing ratio. This is the summary. What we have done? This one, gets from old partners. In this case, 2/3 and 1/3, if I sum these two ratio is equal to 1. Then the sacrificing ratio is equal to new partners new ratio is multiplied with such ratio. In the second illustration, 1/5 and 1/10 is given. If you add up these two, this is equal to the new partners ratio. 1/10 plus 1/5 is equal to 3/10, which is equal to the new partners ratio. In that case, the given ratio itself new ratio. Now come on. Yes, new ratio. New ratio is equal to old ratio minus sacrificing ratio. Here, yes, old ratio being 5/8. What he sacrifices 1/5. In the earlier illustration, J's value into ratio is applied, but here it is not. So directly you are going to subtract. So you have to minutely understand the difference between the earlier model and this model. Clear? What do you have to do? If the sacrificing ratio is given, the total of that is equal to 1, then you need to do two operations here. New partners new ratio is multiplied with the given sacrificing ratios. In another case, if the ratios are total, then the total itself new partners new ratio, then directly that ratio is considered a sacrificing ratio. You can subtract. Here I am not going to use this multiplication. I'm going to simply subtract 1/5. So 40, 25 minus 8, the value being 17/40. Similarly, in case of n, 3/8 minus 1/10 is subtracted. So 40, 15 minus 4 is equal to 11/40. So 17/40, 11/40, 3/10. To make the denominator equal to 40, I have to multiply with 4 in the numerator and denominator, then the ultimate value being 12/40. So now the denominator is same, and cross verify the summation of the numerator should be equal to the denominator. 17 plus 11 plus 12 is equal to the denominator value of 40. So then the value being 17 is to 11 is to 12. Only most of the students gets confused with these two terms. I have given a small hint like to understand. New partners new ratio is given. How he gets it from the other partners, old partners also given. How he gets from the other partners, there's a ratio. If that ratio is total, if it is equal to 1, then sacrificing ratio is equal to new partners ratio is multiplied with that ratio. If the amount here, profit he gets from the old partners, if that ratio is total, that total is equal to the new partners ratio, then that ratio itself, the sacrificing ratio, you can subtract directly. Hope you will be able to understand these two illustrations. Come on, make note of it. Fifth one. Clear? Are you able to understand and differentiate between the fourth one and fifth one? Are you able to do this? Yeah. Make it faster. Online students, come and text me. Yes. Try to solve this yourself. Sixth and seventh, I request you to solve this yourself. 6 and 7. Make it faster. Don't refer the answers. Partners A, B share P&L ratio, P&L in the ratio of 3:2. They admit C into the partnership firm. Partner A sacrifices half of his share. B sacrifices one third of his share. Already we have studied. So what about A's new ratio? Okay. Old ratio minus what he share sacrifices. Old ratio being 3/5 and what he sacrifices? One third of his share. His share is 3/5 and half of his share. Then this will be 3/5 minus 3/10. So 3/10. It's easy. In case of B, 2/5 minus from the 2/5 one third. Then 2/5 minus 2/15. Okay. 4/50. Then C's new ratio. What C gets from A as well as gets from B. Both will be added. Now you can take the LCM. 30, 9 minus 6, 3/30. Am I right? Oh, plus. Okay. 9 plus 4. Okay, okay. 13/30. So new ratio being 3/10, 4/15, 3/30. Make all the denominators equal to same number, 30. So here I multiply 3 in the numerator and denominator. Here I multiply 2 in the numerator and denominator. So 9/30, 8/30, 13/30. Cross verify. Sum the numerator should be equal to denominator. Of course, then you can write simply this way. Question number 7 is one of the interesting illustration where two partners are parallelly joining. Equal partners, they admit Y and Z as partner for 1/5 and 1/6 share. So this is also first type of ratios. Okay. Let the total profit be 1. Balance after incoming partners share. Balance after Y and Z share. 1 minus 1/5 minus 1/6. Take the LCM 30. So 30 minus 6 minus 5. 19/30 is the balance. W's new ratio, the leftover amount 19/30 and W's share being 1/5. 19/150. Sorry, equal, no? Half. Okay. 19/60. Similarly, for x also the same. For x also the same. So 19/60. 19/60. For y it is 1/5. For z it is 1/6. W, x, y and z. To make the denominator equal with 60, I have to multiply with the 12 here, here with the 10. Then 19/60, 19/60, 12/60, 10/60. 19 is to 19 is to 12 is to 10 is the ultimate value. Hope now you'll be able to understand all these things. So with that we have completed the ratios, and we'll move on to the one more last illustration. With that we'll stop today's lecture. So we'll continue the goodwill in the next class. Come on, try this one. A, B and C are partners sharing profits and losses in the ratio of 3:2:1. C retires and D is admitted as a new partner. A and B will continue to share profits the same ratio as before, and D will receive the share of profits equal to that of B. Determine the new profit sharing ratio. So it was a question asked in the examination. So A, B, C and D. Old ratio being 3:2:1. Not given in the text, I think. Okay. It was an interesting illustration I saw in the question, so I immediately added the new book. Not given in your existing text, right? C is retiring and D is incoming. After the retirement of C, A and B will continue to share the old ratio after C's retirement. What's that? 3:2. C has gone out. After C retires, D is admitted. A and B will continue to share profits the same ratio before. So before A and B share the ratio of 3:2. After leaving C, yet they will continue the same 3:2. D will receive a share profit equal to B. So new ratio after D's admission. What's that? 3, 2. D will get equivalent to B. Then the new ratio is 3:2:2. We have not used any mathematical calculation up to now. We have done. It's very straightforward question. Was asked in CMA Inter, I think, carrying 2 marks. So interesting. This one also carrying 2 marks was asked in CMA Inter. Interesting illustration. 7 and 8. Okay. Yeah, finish up copying this, and tomorrow is the practice session up to the content we have covered. Finish up that. The day after tomorrow, we try to finish up admission, retirement, and admission come retirement all. Okay. See you in the next class.